Hey there, Investing Iguanas. Iggy here, and today, we're diving into the surprising truth about Singapore's investors. You might think you know how Singaporeans invest their hard-earned money, but get ready for some eye-opening revelations that could change the way you approach your own financial future. In this video, I'll take you on a journey through the latest trends and insights shaping Singapore's investment landscape. We'll explore why equities are the top choice for investors across all age groups, how Singaporeans are building diversified portfolios, and the key factors driving their investment decisions. But that's not all. I'll also share some little-known facts that might just surprise you and make you rethink your own investment strategy. So, whether you're a seasoned investor or just starting out, this video is packed with valuable information that you won't want to miss. Get ready to take notes, because by the end of this video, you'll have a clearer picture of what it takes to succeed as an investor in Singapore. Let's dive in. As we look ahead to the investment landscape in Singapore for 2024, there are plenty of reasons to be optimistic. A recent report by Fidelity International paints a promising picture, with 51% of Singaporean investors feeling comfortable about their financial situation, a notable 4% increase from the previous year. While Singapore may still be trailing slightly behind some of our regional counterparts like Australia and Hong Kong, this uptick in investor confidence is a clear indication that we're moving in the right direction. But what's driving this positive sentiment? Well, a few key factors are at play. For starters, Singapore's economy has shown remarkable resilience in the face of global challenges, with a steady recovery and growth trajectory. This stability provides a solid foundation for investors to build upon. Additionally, the government's proactive measures and policies have played a crucial role in fostering a conducive environment for investment. From tax incentives to infrastructure development, these initiatives have bolstered investor confidence and attracted both local and foreign capital. Another exciting trend to watch in 2024 is the growing appetite for alternative investments. Singaporean investors are increasingly diversifying their portfolios beyond traditional assets like stocks and bonds. Real estate, in particular, remains a popular choice, with many investors drawn to the stability and potential for long-term appreciation that property ownership offers. Moreover, the rise of fintech and digital platforms has made it easier than ever for investors to access a wider range of investment opportunities, from peer-to-peer lending to cryptocurrency. When it comes to investment preferences, Singaporeans across all age groups seem to favor equities as their top choice. A significant 69% of investors in Singapore own stocks, while 67% have insurance-related products in their investment portfolios. This preference for a diversified approach with a strong focus on equity exposure is a trait shared by investors in Hong Kong as well. Interestingly, this investment strategy differs from the more conservative approaches typically observed in markets like mainland China and Japan, where investors tend to be more risk-averse. The high ownership of stocks and insurance products among Singaporean investors suggests a willingness to take on calculated risks in pursuit of potentially higher returns, while also seeking to protect their wealth through insurance-based investment vehicles. This balanced approach to investing, combining growth-oriented equities with the stability of insurance products, appears to be a defining characteristic of the investment landscape in Singapore and Hong Kong, setting them apart from their regional counterparts. When it comes to investment behavior in Singapore, a few key factors are driving the decisions of investors, especially the younger generation. According to a recent survey, a majority of Singaporean investors, around 53%, are primarily focused on achieving long-term capital growth with their investments. This means they are willing to invest in assets that may be more volatile in the short term but have the potential to generate significant returns over a longer period. On the other hand, about 30% of investors are more interested in generating a regular income stream from their investments, which could involve investing in dividend-paying stocks, bonds, or real estate investment trusts, REITs. This investment behavior makes sense, particularly for younger investors who have a longer time horizon to work with. They can afford to take on more risk in their portfolios, knowing that they have time to ride out any short-term market fluctuations and benefit from the power of compounding returns over the long haul. By starting to invest early and consistently, these younger investors can take advantage of the potential for their investments to grow substantially over time, setting themselves up for a more secure financial future. Additionally, the survey found that Singaporean investors are becoming increasingly savvy and are willing to explore a wider range of investment options beyond traditional assets like stocks and bonds. Many are showing interest in alternative investments such as cryptocurrencies, peer-to-peer lending, and crowdfunding platforms. This diversification of investment portfolios is a smart strategy as it can help mitigate risk and potentially enhance returns. As a young investor in Singapore, it's important to take an active approach to managing your investment portfolio. Gawning Pang, head of equities at Generali Investments Asia, advises focusing on growth assets, especially with interest rates on the decline. Keeping too much cash could mean missing out on potential returns from the stock market. So what should you do? First, work on increasing your earning power. Your ability to grow your wealth through investing depends a lot on how much capital you can invest. Develop valuable skills that allow you to command a higher salary. At the same time, educate yourself on investing by reading books and articles from reputable sources. Next, look for high-quality growth companies to invest in for the long term. These are businesses with strong fundamentals that can weather economic downturns. Avoid companies saddled with a lot of debt. Building a diversified portfolio with blue-chip stocks, REITs, and ETFs can provide stability and opportunities for capital appreciation. The most important thing is to get started, even if it's with a small amount. Time in the market beats timing the market. By starting early, you give your investments more time to compound and grow. You'll also gain valuable experience in how to manage your portfolio through different market conditions. When building your investment portfolio, it's wise to start with a solid foundation of low-risk investments. Singapore savings bonds are a great option as they are fully backed by the Singapore government and offer guaranteed returns over a fixed period. You can invest up to 200,000 Singapore dollars and choose to hold them for up to 10 years with the flexibility to redeem early if needed. Another way to get started is by exploring exchange-traded funds, ETFs, or regular savings plans. These allow you to invest in a diversified basket of stocks or bonds with smaller sums of money on a regular basis, such as monthly. ETFs are traded on stock exchanges, providing liquidity, while regular savings plans automate your investments so you can benefit from dollar-cost averaging. As you gain more knowledge and confidence in investing, consider diversifying your portfolio across different asset classes, sectors, and geographies. This strategy helps to spread out your risk so you're not overly exposed to any single investment. It also allows you to potentially capture growth opportunities in various markets. For example, you might invest in a mix of stocks, bonds, and real estate investment trusts, REITs, across industries like technology, healthcare, and consumer goods, both in Singapore and internationally. For investors with a higher risk appetite and a longer investment horizon, exploring private market investments could be an option to further diversify and potentially enhance returns. Private equity involves investing in companies that are not publicly traded, often with the goal of improving their operations and profitability before selling the company or taking it public. Private credit refers to loans made to private companies by non-bank lenders, which can offer attractive yields. Venture capital focuses on investing in early-stage, high-growth startups with the potential for significant returns if the companies succeed. However, it's crucial to understand that private market investments come with higher risks and longer lock-in periods compared to public market investments. They are also less liquid, meaning it can be harder to sell your investment if you need the money. As with any investment, make sure to do your due diligence, understand the risks involved, and ensure that the investment aligns with your financial goals and time horizon. Consider consulting with a financial advisor to help you build a diversified portfolio that suits your individual needs and risk tolerance. The key to successful long-term investing is to start early, diversify your portfolio, and stay the course even through short-term market fluctuations. By beginning to invest as soon as possible, you give your money more time to grow through the power of compound returns. Even small amounts invested regularly can add up substantially over time. When building your investment portfolio, it's crucial to diversify across different asset classes like stocks, bonds, and real estate, as well as within each asset class. This means investing in a variety of industries and companies rather than putting all your eggs in one basket. A well-diversified portfolio helps manage risk by ensuring that when some investments are underperforming, others may be thriving, smoothing out overall returns. As you embark on your investing journey, take time to educate yourself on financial markets and products. However, don't let yourself get caught up in daily market movements or chasing the latest hot stock tip. Develop a sound, long-term investment plan aligned with your financial goals and risk tolerance. Then stay disciplined in following that plan, resisting the urge to make emotional decisions based on short-term noise. All right, investing iguanas, we've covered a lot of ground today. We've seen how Singaporean investors are embracing equities, diversifying their portfolios, and focusing on long-term growth. We've also uncovered some surprising truths, like the fact that nearly half of Singaporean investors are boosting their cash positions despite the potential for missed opportunities. But here's the thing, knowledge is power, and now that you're armed with these insights, you're in a better position to make informed decisions about your own investments. Whether you're just starting your journey or looking to take your portfolio to the next level, remember the key takeaways: start early, diversify your investments, and stay focused on your long-term goals. And if you found this video helpful, don't forget to give it a like and share it with your friends and family. Your support means the world to me, and it helps me continue creating content that empowers you to take control of your financial future. If you're not already part of the Investing Iguana community, what are you waiting for? Hit that subscribe button and join the family. I've got plenty more insights, tips, and strategies to share with you, and I don't want you to miss a single one. Until next time, Investing Iguanas, keep learning, keep growing, and keep investing wisely. Remember, the path to financial freedom starts with a single step, and I'm here to guide you every step of the way. This is Iggy, your Investing Iguana, signing off.